In terms of that growth momentum, is that sustainable going forward, or will that be impacted by a slowing China given their exposure to the Chinese market?
Thanks, Haslinda, Rish, for having me on the show. Absolutely, I think there are some risks to growth. But on the flip side, we are seeing very sustained trade, trade loans holding up quite well. Singapore property market is doing well. We have both mortgages holding up, developers are building land bank, and even the logistics sector is looking quite good. There's significant credit demand there. So what we are seeing are, yes, there are risks. There are risks across the board, especially with slowing China. But on the flip side, there are very significant positives. And we've also seen a lot of banks telling us that the capex is starting to move up now in bits and bobs, but it looks like it's heading in the right direction in large part of South and Southeast Asia. So while we acknowledge the risks, my sense is the guidance that we got from the banks seems to suggest mid to high single-digit loan growth, which I think where we end up in that range remains to be seen, but it looks like we are heading in the right direction.
DBS, which is the largest lender in Southeast Asia, has been making acquisitions to help its growth. Do you see DBS building on its acquisition plan after acquiring Citi's assets?
If I can take a step back and think about acquisitions, it's a function of three things for any bank: capital, the extent of liquidity on the balance sheet, and the opportunities. Over the last 2 years, what we saw was very significant rejig of multiple business groups. A lot of banks did rethink their strategy, and if they were not great at any particular geography, they chose to make amends. And that is where I think it opened up opportunities for all the three Singapore banks. And we saw a couple of acquisitions across DBS, UOB over the last few months. I suspect that over the next 2 to 3 years, the pace of acquisitions for across all the three banks may be slower than what we had in the last couple of years, primarily because we do not have very large-scale exits anymore. That's one. Second, the organic growth is starting to come up for all the banks, and they're starting to return capital. Regulators are more open to the idea of returning capital. Hence, I think the focus is going to be more on how much earnings accretion can we get from the deals rather than necessarily adding to the deals. We may see more capital being allocated to the markets where the banks have bought franchises, but not necessarily add anything meaningful. At least that's my sense for now, but we'll wait and watch.
Harsh, what is the key metric you're going to be looking at in earnings from these banks, and how will that inform you as to which one is the best positioned?
Thanks, Rich. The single largest driver for the Singapore banks over the next 3, 6, 12, 24, 36 months is going to be net interest margin. They have very low cost of funds. A large part of deposit base is what we call CASA, current and savings account. Is essentially transaction accounts, very low rate sensitivity. And as rates move up, while the asset yields will go up, loan yields will go up, but cost of funds will lag very meaningfully. And to the extent the banks can manage the asset yields while still sustaining the market share and credit risk, while limiting the increase in deposit rates, that's what's going to show up in NIMs. And that, I think, is the single largest driver. And in fact, what we have seen across Singapore banks over the last almost 24 months now, beyond the last 18 months actually, is that expectation that rates have started bottoming out, asset quality is good, and so now it's very firmly in favor of margins.
Harsh.
And we are very well positioned here.
Harsh, and getting to, the ones which are best positioned, and just on top of that, just looking at something you said, curiously, you mentioned organic growth earlier. Let's take the example of DBS. It made an acquisition of a few Citi's retail operations. Do you think they need to make more acquisitions in that particular realm in order to get themselves more critical mass and also, of course, directly then help their NIMs or their interest rate, their net interest margins? Very quickly.
Yeah, thanks, sir. I think it's the inherent franchise in Singapore for all the three banks, which actually underpins that strength on NIM. So it's less to do with acquisitions and more to do with how well they can manage the core franchise. And that's the reason why I think the focus is going to be managing the franchise rather than adding more at this point in time.